welcome to the first series of videos for the Hilltop Views blog. We would like to share some of our thoughts from Hilltop's fourth quarter review of the investment markets. I'm Chris Hostetler, and today David Wise and I are going to discuss the international equity markets. We believe at Hilltop that 2017 marks a changing of the guard between U.S. and international investments. For years following the financial crisis in 2008, the U.S. market outperformed the international markets pretty consistently. This year, however, we're seeing international equities broadly performing better than the U.S. Let's look at a chart that illustrates what we're talking about here. This shows the last 20 years of performance for the U.S. and the international markets, but let's focus specifically at the trend since 2009. The gray line shows the movement of the U.S. stock market, and the purple line represents foreign stocks. Over the last 5 years in particular, the U.S. markets have substantially outperformed the international markets. We believe that we're likely to see a reversion to the mean, which translates to latent opportunity in the international markets. If we're right, then this year's trend of foreign stocks beating U.S. stocks could continue. Now, as we get into this, there's one thing that I would like to clarify. We often talk about the international markets as being one asset class, which leads to a risk that we think of them as a uniform investment. But we need to remember that every country's market is unique. As an example, the outlook for the United Kingdom is quite different from that of the mainland Eurozone right now, primarily because of the transition underway as the UK divorces from Europe. That being said, we do see today a broadly synchronized global expansion underway, where most of the world's economies appear to be growing at the same time. We do believe there's a low risk of recession in most of the international markets as well. Further, we believe we're likely to see higher economic growth in the emerging markets as opposed to the developed markets. And one final important point is that strengthening foreign currencies, as we've seen this year, generally boosts returns for U.S. investors in international stocks. If foreign economies strengthen and their currencies strengthen as a result, you as a U.S. investor could get more dollars back when you sell your investment. Now, let's talk about risks in these markets. A big one, of course, is the political situation in the Eurozone, as highlighted by the UK's vote last year to leave the Eurozone. While the Brexit is a blow to Euro stability, we do not believe it is an existential threat. I liken the current political situation in Europe to what the U.S. states went through in the early days of the Union. Early on, Americans viewed themselves as citizens of their state, but at some point they began talking about themselves as citizens of the United States. Now, historians will argue about how long this process took, but the key is that it was not certain in the early days that the U.S. would become as cohesive and strong an economic union as it did. It remains to be seen whether Europe will be able to pull off the same feat, but we think we will see further economic consolidation, which would generally be a positive economically. Other foreign risks include North Korea. Clearly there's a human risk to the situation there, but we are also monitoring the risk to the financial markets. And China. As China continues to attempt to slow its growth to a more sustainable rate, there continues to be a risk of asset bubbles or a more severe downturn. Now, I'd like to hand the presentation to Dave, who will focus on some of the opportunity we see.
Thanks, Chris. So we've really felt that the international equity market has been primed to outperform for some time. And when we look, generally speaking, at a market as it begins to recover, smaller companies actually tend to outperform their larger counterparts, and especially when we see domestic demand really drive growth forward. Because we believe we're heading into this changing of the guard, per se, as Chris mentioned, where international growth starts to take its course, an opportunity arises within smaller companies in the international market. I've highlighted a few of the key factors that we're currently looking at in the slide, and really the story has been developing over the last year or so, where we've seen new growth expectation push valuations further and back into attractive territories. And when we look at the cyclical nature of the international small companies, we actually see further growth potential. So what do I mean when I say cyclical? Industrials, technology, real estate, healthcare, sectors and companies that really benefit from a boost in consumer spending and favorable government policies that aid recoveries. And as we see these domestic economies continue to recover and expand, we think this is a great area moving forward. In addition to this growth story, we feel like international small cap stocks are going to provide additional diversification within a portfolio, and they really mesh well with their larger counterparts. So that wraps up our thoughts on the current opportunity that we see in the international small cap space. Now, we won't go on any specific changes that we're currently making at this point in time, but through our process, we're always considering the risks and rewards of our decisions and trying to account for them in our portfolios. I want to thank everybody for tuning in to our inaugural series of the Hilltop Views video blog. We're looking to provide as much content as possible to give you as much insight into our thoughts and decision-making process.